most people don't understand this. The Fed certainly doesn't seem to understand it. So we do not think the greater risk here is inflation. Commodity prices are the first place you'll see inflation brewing. And commodity prices are determined at the margin. So incremental demand relative to supply, which shot commodity prices up during the COVID crisis. And we had not only COVID, but the war in Ukraine exacerbating that supply shock. Now you have them coming down, and we don't know what's going to stop them from coming down further now, perhaps to the lower end of this range. Hopefully not lower, because that will be mean we'll be in more of a free fall situation, which of course we do not want.
Escalating mortgage rates and persistently high home prices offer little solace to already disheartened home shoppers in the current climate. The national average 30-year mortgage rate, reaching a 23-year peak of 7.79% by the end of October, experienced a slight deceleration in the first week of November. According to Freddie Mac, the 30-year fixed rate eased by 3 basis points to 7.76% in the week ending November 2nd, providing a modest reprieve after 7 consecutive weeks of increases. It's noteworthy that a basis point represents 1/100th of a percentage point. Just 2 years ago, some mortgage rates were comfortably in the low 3% range, underscoring the stark contrast with the present high rates and home prices. In response to these challenging conditions, monthly existing home sales have sagged for the 4th consecutive month, with a 2% decline in September compared to the previous month's 0.7% dip. This downturn is observed across all 4 major U.S. regions, as reported by the National Association of Realtors. Cathie Wood shares her perspective on the market conditions, highlighting the housing market's decline and its correlation to the financial crisis period.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
Housing affordability has been destroyed with the interest rate hikes that we've seen over the last year and a half. And you can see that in this chart. The National Association of Realtors Housing Affordability Index. In fact, I think you have to go back to the early 80s, late 70s to see affordability ratios as low as we are seeing them now. And of course, housing, by some measures, sales are down 40%. Here's existing home sales. And you can see we are below where we were during COVID, when the economy just screeched to a halt. And we are in the same territory where we were in 08-09, when we were going through the biggest financial crisis of our lives. So that just gives you a sense of how depressed the housing market is. And people are just not going to move because they have 2.5–3% mortgage rates, and they don't want to roll over into 7.5–8% mortgage rates or higher. So trapped, I think, is a good word for that. Another very cyclical sector, the auto sector. You can see it's a mature sector. It doesn't get much above 17.5–18 million units. Hasn't since 85, except on rare occasions. And yet you can see from this chart that we never got back there. And sales at roughly 15.5 million units are very slow by historical standards. And we think they're going to start falling again. This is a big ticket item. Unemployment, we believe, is going up. Students are now having to repay those loans after a 2-year plus moratorium. And so this kind of big ticket is going to suffer, we believe. And so that will contribute to the recession we see ahead. Again, this has been part of a rolling recession. It's been on its way down for a while. And I'm going to present now 3 charts from our friends at ISI Evercore. They do surveys of economic activity every week. And one of the things you've heard me say on In the Know is that we are watching our companies report and listening to these earnings calls. And companies are basically saying, it's getting really bad out there. But we weren't seeing the same thing from economic statistics, and we were puzzled why markets would pay attention to macro indicators when companies themselves are saying, something is not right out there. Now, you will hear the way that the financial news broadcasts talk about earnings. They'll say, oh, revenues beat expectations, earnings beat expectations, but those expectations have been pulled down all quarter. Revenue and earnings are weak. And I think according to our analysis, and this is pretty fresh, about 30% of all companies in the S&P 500 have reported revenue growth that is negative on a year-over-year basis. You don't see that in the macro statistics. But more and more companies are reporting that revenues are falling on a year-over-year basis. That is a recession indicator if there are ever one.
Leading global banking executives expressed their apprehensions on Tuesday, highlighting concerns that the financial sector's next crisis could emanate from escalating geopolitical uncertainty, potentially challenging the resilience of financial markets. While acknowledging the industry's susceptibility to regulatory tightening, the consensus among top executives is that the catalyst for the next global financial crisis is likely to emerge from the geopolitical, or political arena. James Gorman, chairman and CEO of Morgan Stanley, conveyed this perspective at the Global Financial Leaders Investment Summit hosted by the Hong Kong Monetary Authority. Gorman, along with over a dozen other top executives from international firms, deliberated on the potential risks facing the financial sector. Gorman emphasized the observable challenges to democracy in various countries globally, although he did not provide specific details. These discussions unfold against the backdrop of the Israel-Gaza conflict, contributing to heightened uncertainty in the global economic outlook. Simultaneously, the prolonged Russia-Ukraine war and lingering tensions between the U.S. and China further contribute to the prevailing geopolitical complexities. Despite diplomatic efforts to foster closer ties between the leaders of these two superpowers, concerns persist within the financial industry regarding the impact of geopolitical events on market stability.
Sometimes you have to step back from the day-to-day and gain perspective to understand where you are, and in the case of commodity prices, where they are. So this is indexed to 100, which I think was a 1980 number. And look where we are. We're back where we were in the early 80s. Commodity prices have gone nowhere. And if you want to look at recent times, sure, you can see the supply chain shock that we went through that took this metric up from roughly 60, roughly doubling it, 60 to more than 120. But it's coming down now. It's down more than 25% from its recent peak. And if you look at it again, perspective is everything, since the 08-09 crisis, you'll see that it is in a downtrend. Deflation. Most people don't understand this. The Fed certainly doesn't seem to understand it. So we do not think the greater risk here is inflation. Commodity prices are the first place you'll see inflation brewing. And commodity prices are determined at the margin. So incremental demand relative to supply, which shot commodity prices up during the COVID crisis. And we had not only COVID, but the war in Ukraine exacerbating that supply shock. Now you have them coming down, and we don't know what's going to stop them from coming down further now, perhaps to the lower end of this range. Hopefully not lower, because that will mean we'll be in more of a free fall situation, which of course we do not want. Here's the picture of non-farm unit labor costs. The bears would have had you believe that this move up starting in 2010, unit labor costs were negative back then. Compensation growth was held down during 08-09, and productivity actually increased. So unit labor costs were going down. They crossed over zero in mid-2015 and had been going up, and many people thought, okay, COVID let the genie out of the bottle, and we did see unit labor costs go up as labor was so difficult to get. But just look at it now, down to 1.8% on a year-over-year basis. So Unit labor costs takes compensation, both compensation and productivity, into account. So it's output per man hour, that's productivity, and unit labor costs are compensation costs less productivity growth. So we're at 1.8%. That's below this 2% inflation target. And the Fed has been very worried about the labor market causing inflation. This chart, this evidence would suggest that has not happened. It is not like it was during the 70s. Look what happened. We got into the double-digit range here, where we've just reversed. And I think this was an important indicator for the Fed this week. And I think they're a little bit more on high alert that they may be making a mistake here. They won't say that their vote this week was unanimous to hold for higher and pay attention to the data.
The notion that history repeats itself is starkly evident in the current housing market scenario, which, in some aspects, surpasses the dire crash of 2008, according to an analysis by Goldman Sachs. Mortgage rates, reaching almost 7.5%, are at their highest levels in over 2 decades. Compounded by decades of underbuilding, home prices continue their upward trajectory, with the average sale price in the U.S. nearing $500,000 for the second quarter of 2023, almost double the price during the 2008 housing bubble burst. Goldman Sachs, in a sobering assessment, underscores the severity of the housing cost situation. The Atlanta Fed's Housing Affordability Monitor reveals a decline beyond 2006 levels, with affordability dropping nearly 8 percentage points year-over-year as of July 2023. Despite concerns about housing affordability, the landscape differs significantly from 2008. Back then, zero down payment mortgages and tapping into home equity fueled real estate prices. Today, the scarcity of homes for sale is a primary driver of high prices, with housing inventory levels plummeting by a staggering 60% from September 2018 to September 2023, reaching below 700,000 active listings. As reported by the current confluence of escalating mortgage rates and climbing home prices poses a formidable challenge for potential homebuyers. In contrast to the last crisis, where higher loan payments weaken home prices, today's dynamic sees both mortgage rates and home prices rising simultaneously. The analysis by Cathie would prompts reflection on these market dynamics. Share your thoughts in the comments section below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.